Why U.S. real estate is so flawed. For a variety of structural, psychological, and economic reasons, the U.S. real estate market is frequently perceived as having flaws. The prevailing consumer optimism regarding affordability and the inflated housing crisis caused by loose credit standards pose serious challenges for investors, buyers, and sellers. In this video, we will address this issue in detail. Number 7. Credit expansion and lending standards. The proliferation of credit has had a substantial impact on the U.S. housing market, especially in the years preceding the 2008 financial crisis. Lenders loosened their underwriting guidelines during this time, granting subprime mortgages to applicants with dubious credit records and little money. More people entered the market and were able to obtain credit as a result, which caused a spike in home purchases. But many of these borrowers were unprepared to manage homeownership's financial obligations, especially in the face of escalating interest rates or unforeseen economic downturns. Subprime mortgage default rates surged as a result, causing a wave of foreclosures that completely destroyed many communities. The crisis made clear the need for more cautious lending practices, as well as the risks associated with relying too much on credit expansion. Despite the tightening of lending standards following the crisis, there is still concern about the cyclical nature of credit expansion. The ease of getting credit can lead to riskier borrowing habits, and when the economy changes, it can cause big market corrections that disproportionately impact the most vulnerable groups of people. The vulnerability of the U.S. real estate market to credit cycles emphasizes the need for stronger regulatory supervision and improved coordination between lending policies and long-term market stability. Number 6. Consumer perception and market sentiment. In the real estate market, consumer sentiment is very important because it affects both buying and selling behaviors. According to recent surveys, the vast majority of Americans, or roughly 86%, thinks that the current market is not a good time to buy a home because of the rising interest rates and the rapidly increasing prices of real estate. The market dynamics may be impacted by this widespread negative sentiment if demand declines. Holding off on buying a property can start a feedback loop that drives down prices and discourages new building. Furthermore, unfavorable opinions have the potential to discourage investors, which would prevent the market from receiving the capital needed for expansion and stability. Because of the uncertainty this environment creates, it is challenging for both buyers and sellers to make wise decisions. Rising mortgage rates and high prices have priced many first-time and low-income buyers out of the market, making the impact of consumer sentiment especially noticeable in the current market. As a result, the percentage of Americans who own a home has decreased, and younger generations now face considerable obstacles to getting into the market. A combination of policy interventions, including more housing supply and focused assistance programs, as well as improved public education on the long-term advantages of homeownership, will be needed to counteract the negative sentiment. Number 5. Flawed economic assumptions. The U.S. real estate market often operates under flawed economic assumptions that can misguide investors and policymakers alike. Many stakeholders believe that investing in real estate is free of risks since properties appreciate over time regardless of overall economic conditions. This idea may encourage over-leveraging, in which investors incur high levels of debt in an effort to realize their imagined profits. Moreover, investing strategies may become less diverse as a result of the presumption that demand will always exceed supply. When economic downturns occur, these assumptions can lead to significant financial losses, as properties may not perform as expected. The reliance on historical trends without considering changing market dynamics can create vulnerabilities within the market. For example, the COVID-19 pandemic has disrupted many of the assumptions that drive real estate investment strategies, changing demand for specific types of assets and locations. Investors who did not adjust their portfolios or adapt to changing market conditions faced heavy losses. The flawed economic assumptions underlying the U.S. real estate market highlight the need for careful due diligence, contingency planning, and risk management strategies to assure stability and sustainability. Number 4. Supply and demand imbalances. The persistent mismatch between supply and demand in the American real estate market, especially with regard to affordable housing, is one of the most urgent problems. Regulations that impede the construction of new homes include onerous zoning regulations and drawn-out permitting procedures. Numerous local governments have put in place zoning regulations that restrict the construction of multifamily housing, including apartments and townhouses, and give preference to single-family homes. There is a dearth of affordable housing options in many urban areas as a result of these policies, which are frequently motivated by worries about neighborhood character and property values. In addition, it is becoming more and more difficult for developers to construct affordable homes due to rising construction costs caused by a lack of labor and rising material prices. Because there are so few affordable housing options in many urban areas, prospective buyers are forced into bidding wars that drive up prices even further. This disparity not only has an impact on homeownership rates but also makes homelessness and unstable housing worse, posing a larger social problem. A multifaceted strategy will be needed to address the supply-demand imbalance, including zoning reform, increased funding for the development of affordable housing, and incentives for the construction of a variety of housing types in areas with high demand. Number 3. Investment risks and property losses. Real estate investing is fraught with dangers that could result in significant losses. Property values can be greatly impacted by a variety of factors, including changes in local market conditions, natural disasters, and economic downturns. For example, property values in hurricane or wildfire-prone areas may vary significantly due to environmental risks. A poor property manager can also result in higher vacancy rates and lower rental income, which can further put a strain on an investor's finances. The unpredictability of property investments is highlighted by the fact that 1 in every 20 insured homes, according to the Insurance Information Institute, files a claim each year. These risks underscore the significance of comprehensive market research and risk assessment for investors, given that losses in a volatile market can be substantial. These risks have been made worse by the COVID-19 pandemic, and as a result, many investors are now dealing with issues like tenant defaults, decreased rental income, and higher operating expenses. Consequently, certain investors have modified their approaches, emphasizing more durable property kinds and areas. To ensure long-term success, investors must be ready to effectively manage the inherent risks associated with real estate investing. Number 2. Lack of affordability and accessibility. Due to the fact that rent and home prices are often rising faster than incomes, the U.S. housing market is severely plagued by an affordability crisis. Due to this, a large number of low-income and first-time buyers have been priced out, which has led to a decline in homeownership rates, particularly among younger generations. A record 49.7% of renters are cost-burdened, meaning they pay more than 30% of their income on rent, according to the Joint Center for Housing Studies at Harvard University. This statistic represents the proportion of renters having this problem. Many families are forced to spend a disproportionate amount of their income on housing due to the lack of affordable housing options, which leaves less money for other needs like healthcare, education, and savings. This problem exacerbates wealth inequality and has a disproportionately negative impact on marginalized communities. A number of factors, such as a lack of available housing, high building costs, and stagnating wages, are contributing to the affordability crisis. A multifaceted strategy will be needed to address this crisis, including raising the number of affordable housing units built, offering down payment assistance and homebuyer education programs, and putting laws in place that shield tenants from being evicted or forced to move. The stability and inclusivity of the U.S. housing market will continue to be threatened by the lack of affordability and accessibility unless there are major interventions made. Number 1. Speculative investing and financialization. Speculative capital has poured heavily into the U.S. real estate market, mostly from institutional and private equity firms. These investors frequently put short-term financial gain ahead of long-term community stability, which raises costs and restricts access to home ownership. The National Association of Realtors reported that in 2021, investors made up 26% of all home sales, an increase from 15% in 2020. The affordability crisis is partly caused by the financialization of housing, which has turned it from a basic necessity into a tradable asset. Because speculative investors may quickly withdraw their capital in response to economic shocks, they can also increase market volatility and risk. For instance, some institutional investors quickly sold off properties during the COVID-19 pandemic, which contributed to market instability. The ubiquity of speculative investment has sparked worries about long-term residents' potential displacement and the fair distribution of housing resources. Policies that deter the use of housing as a speculative asset, such as higher taxes on investment properties and limitations on corporate ownership of single-family homes, are necessary to address the effects of speculative investing. Policymakers and industry stakeholders can work toward a more resilient, equitable, and efficient real estate market that meets the needs of all Americans by recognizing and resolving these systemic issues. Thanks for watching our video, and don't forget to subscribe to our YouTube channel.